The greatest threat to the US economy has never been the AI hype cycle. It wasn't China, and it sure wasn't the guy with a signature tan calling the shots from the Oval Office. No, it's something far more mundane, something most folks wouldn't spot unless they've tunneled deep into the weeds of global finance, and that's precisely why it's flying under the radar. If you've been scratching your head over why mortgage rates are stuck in the mud, refusing to budge downward, why stocks keep throwing tantrums every couple of months, and why the Federal Reserve keeps jawboning about rate cuts while the financial squeeze just won't let up, the story doesn't kick off in DC. It starts halfway around the world, in Tokyo, to be exact, with what might be the dullest investment vehicle on the planet, Japanese government bonds. The nation famous for pulling in American anime fans has also been the unsung hero, the sticky tape patching together the world's financial plumbing for the last 3 decades. And now that tape is starting to lose its grip. To grasp why Japan matters so much, we need to hit rewind to the early 1990s. Back in 1990, Japan's legendary asset bubble finally popped. Property values tanked, stock markets cratered, and the country plunged into what's infamously called the lost decades, a grueling stretch of economic limbo that dragged on for 30 years. Growth flatlined, inflation, forget it. Wages barely budged. It felt like someone slammed the economy's pause button and misplaced the remote forever. So the Bank of Japan pulled out the central bank playbook for desperate times. They slashed rates to zero, then plunged them into negative territory. When even not all that, they rolled out a policy dubbed yield curve control. Sounds like a comic book baddie, but it really just meant they capped long-term bond yields. Market be damned. In essence, Japan's government superglued interest rates to rock bottom. For years on end, those Japanese government bonds turned out next to nothing in return. That spelled big trouble for Japanese savers and institutions. Picture this. You're running a massive Japanese insurance giant, a pension fund, or a major bank sitting on billions in assets, and your own government's bonds are paying zilch. You've got 2 lousy options: sit on dead cash with 0 yield or hunt for deals abroad. They picked door number 2. Japan kicked off a decades-long international spending binge, morphing into the top foreign owner of US Treasury, a heavyweight buyer of mortgage-backed securities, and the globe's biggest net creditor, a fancy term for turning into the world's personal cash machine. And it wasn't some starry-eyed action for America driving this, it was cold, hard math. Let's break it down. Say you've got this investor named Bob, itching to turn a profit. He taps the Japanese markets, borrows yen at rates hugging zero, swaps those yen for dollars, snaps up US Treasuries yielding around 4%. After hedging fees and currency swaps, he still banks the difference. That's the yen carry trade in a nutshell. Borrow cheap in yen, park it in higher yielding stuff overseas. With borrowing costs that low, it's not just safe treasuries on the menu. They scooped up tech shares, real estate deals, emerging market bets, anything breathing with a better payout than zero. For years, this flow pumped trillions into global markets, acting as a stealth liquidity engine. At its height, banks pegged the yen carry trade north of $1 trillion. It was like the whole financial world was wired to Japan's signal. But the whole setup hinged on one fragile bet. Those Japanese yields would stay pinned near zero indefinitely. That bet shattered in 2024. The Bank of Japan ditched yield curve control in March, then hiked rates for the first time in 17 years, lifting from negative 0.1% to a slim 0 to 0.1 range. They followed up with another bump on July 31st, pushing to 0.25%. The unwind hit hard right after, with the yen carry trade unraveling fast. On August 5th, the Nikkei 225 nosedived more than 12% in one brutal session, the steepest single-day plunge since Black Monday in 1987. The S&P 500 shed about 6% over that chaotic week as panic rippled. Markets were screaming one thing: they're rot. Rising Japanese yields flip the script in 2 big ways. Borrowing in yen gets pricier overnight. Hedging against yen swings, that costs more too. Suddenly, the easy money game turns into a grind. Bob's 4% US Treasury yields not looking so shiny anymore. That sparked the yen carry trade's slow motion implosion. Math no longer added up, so the flows reversed. Capital that had gushed out of Japan for decades started flowing back home. Call it repatriation, and it's looming as one of the stealthiest shocks in global finance right now. Investors are waking up to a harsh reality. The bargain bin source of worldwide liquidity for 30 years just jacked up its prices. But here's the real kicker: why this hits home. Japan wasn't just any bidder for US debt. They were the rock-solid price-blind anchor for long-term treasuries. Those long bond yields, Jerome Powell doesn't dial them in. The Fed owns the short end, the overnight stuff, but the 10-year, 20-year, 30-year yields, they're slaves to supply and demand. Everyone's fixated on the wrong dial. Let me hand it to Ray Dalio, the hedge fund titan behind the world's biggest such outfit. Watch the bond market. The bond market is the basis. It's the backbone of all markets. It is the risk-free, meaning default-free, probably default-free, interest rate that determines what all asset returns are going to be. And when there's a breakdown of the supply-demand picture for the bond market, you see a certain type of market action. You see long rates rising relative to short rates. You see the currency go down. You see gold go up because there's a movement out of that bond market because there's a supply-demand imbalance. When that happens, that raises interest rates, and it puts the Federal Reserve and other central banks in a bind. So while the crowd dissects every Powell presser like the next blockbuster trailer, they're missing the yield curve's long tail. The Fed nudges it indirectly, sure, but supply and demand call the shots there. Toss in America's $1 trillion annual debt
deficits, and even a dip in buying power packs a wall up. The Treasury's churning out mountains of fresh debt yearly just to keep the engine humming. As issuance balloons, somebody's gotta swallow it. Japan was the steady hand in that absorption squad for decades. But hold up, before I unpack what happens if they tap out, quick break, because this one's brought to you by Gamma. I swear by Gamma myself. The real grind in cranking out finance explainers isn't the digging, it's wrangling a mess of half-baked thoughts into something that flows. Take unpacking the cross-currency carry trade. Your brain's a storm of scribbles, loose threads, and aha links that evaporate on paper. Botch the framework and poof, the whole thing crumbles. Enter Gamma, the smart link from brain dump to broadcast ready. How I roll with it? I dump my raw haul, data dumps, I analyst PDFs, frantic notes, straight into Claude, flip on the Gamma connector and settings, and boom, I prompt it to spin up a deck in the pile. Seconds later, it sculpted a crisp outline, turning chaos into a slideshow that syncs. Fresh intel hits Claude, it ripples right into the Gamma build. No full rebuild needed. Gamma keeps the fire lit from ideation to polish, and it's not Claude exclusive. Hook it to GitHub, Notion, even Gmail. No more ideas rotting in notebooks. Serious? Swing by gamma.app or snag it via Claude connectors. Shout out to Gamma for backing this deep dive. Now, back to the fallout if Japan pulls back on US Treasury, lose one of history's steadiest big-ticket buyers, and yields have to climb to lure fresh blood. That's supply and demand economics, raw and real. It sets up this mismatch. The Fed slashes the Fed funds rate, short yields dip, but the long end stays stubborn. Hello, steepening yield. If those long rates dig their heels in, it's no longer a bond nerd's yarn. It's the spark for everything else. Stock models, they discount future cash at those long yields. Higher rates shrink today's value of tomorrow's dollars, squeezing valuations. Shares fetch lower multiples even with solid earnings. Markets jitter without warning, even as headlines hum along. But stocks are just the appetizer. That 10-year Treasury yield isn't some Bloomberg footnote. It's the yardstick for money's true cost, underpinning every price tag out there. Mortgages track it tight, so if the 10-year won't drop, don't hold your breath for 3% home loans. Fed can chop rates till the cows come home, but aiding global demand keeps the curves far and elevated. Result? Mortgages stay sky high. Home buying affordability chokes. Refis stall and sales crawl. Zoom out to corporate debt and it's the same drill. Flashback to 2020 and 2021 when cheap money flowed like cheap beer. Firms issued bonds like it was going out of style. Rates slashed deep. Easy credit juices mergers, pumps valuations, revs the engine. It's the lifeblood of business. But stubborn borrowing costs, they starve the beast. Risk appetite cools, expansion slows, cash gets stingy. That's the core of this whole tale. For 30 years, America surfed the wave of the planet's mega carry trade. Now it's cresting and crashing. As Dalio nailed it, bonds are the spine, the rate setter for every return out there. We're witnessing a live wire shift cracking that foundation. Why is the mainstream finance glossing over it? Simple. It's not sexy. Won't light up Twitter. Who clicks on yen carry unwind in Japanese capital shifts? That demands patience, layers, brain power beyond endless scrolls. Folks crave the sizzle, inflation scares, AI mania, Nvidia's latest pop, the loud, shiny, headline-grabbing stuff. So the spin simplifies to pablum. Fed cuts, conditions loosen. Not always. That's the pitch we're swallowing. One snip fixes the mess. Liquidity's on tap. Debt always finds a sucker. But what if it doesn't? What if Uncle Sam's top foreign lender hits the brakes? Global liquidity clamps down, and liquidity is market oxygen. When it ends, the price of cash surges everywhere, from equities to homes to boardroom loans. That's why this channel exists, to spotlight the signals that count, the ones legacy outlets skip because they don't drive dopamine hits. If you're game for the unvarnished truth on market machinations, smash subscribe, ring the bell. I'll unpack what the suits won't, because the loud risks, they're baked in. The quiet killers lurk right in the open. What do you think? Be sure to tell in the comments.